Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers. Seven straight up days, and suddenly the Nasdaq looks like it never heard of geopolitics. This is classic relief rally behavior. Markets priced in worst case war, then quickly repriced peace, or at least a pause. With ceasefire hopes building, risk appetite is back, oil has cooled, and tech, being long duration, benefits first. But here's the catch: nothing structural has changed. Supply chains are still dented, inflation risks are still lurking, and this rally is running more on hope than on hard data. So yes, momentum is strong, but it's the kind that checks headlines before checking fundamentals. $2.6 trillion moves daily across borders, and nearly 40% still flows through London. Not New York, not Singapore, London. Turns on time zones are the ultimate monopoly. Catch Asia closing, Europe trading, and the US waking up, all in one shift. The US is big but more domestic focused. Asia is rising but still fragmented. London is a global middleman that never sleeps, just changes accents. And here's a real signal. Despite Brexit, regulation fears, and shifting power centers, capital still prefers familiarity over geography. In FX, trust compounds faster than interest rates. Volatility is quietly waving the white flag. The VIX is back near 20, and even in the fear of fear, the VIX of VIX has cooled off. Transaction markets are no longer trading missiles, they're trading macros again. This is classic positioning unwind. Hedge funds that rush for protection are now unwinding it just as fast. Asia equities bouncing back, that's confirmation. Risk appetite is creeping on while headlines are still catching up. But don't get too comfortable. When volatility falls this quickly, it usually means complacency is rising just as fast. And geopolitics has a habit of returning uninvited. While everyone's glued to Hormuz, Russia just rang the cash register. Ural's at $120 a barrel, highest in over a decade, and the driver isn't just supply, it's rerouting. India stepping up to nearly 2 million barrels a day tells you everything. Sanctions did not stop flows, they just changed directions. Cheaper crude finds willing buyers, and suddenly geopolitics becomes a logistics business. The real twist: a chunk of this trade is dodging the dollar, quietly chipping away at the global financial order one barrel at a time. So when the Middle East heats up, Russia doesn't just watch, it invoices. Everyone's asking when the FIIs will come back. So the better question actually is, when will prices give them a reason to? Flows follow returns, not the other way around. And right now the setup is quietly improving. Valuations are cooling, the rupee looks undervalued on a RER basis, and macro stress is peaking, not worsening. Yes, the capital account slipping into deficit looks ugly. That's often when the opportunity quietly walks in. Historically, FIIs show up when things feel uncomfortable, not when headlines feel heroic. This is rare territory. India's top 10 names trading near or below historical valuations while still delivering solid return ratios. That combination usually shows up only when the markets are nervous, not when fundamentals are broken. Think about it. High quality balance sheets, steady ROEs, and now more reasonable pricing. This isn't distress, it's discomfort. And markets often misprice discomfort as risk. March 2020 was panic. Today, it's hesitation. Big difference. Back then you bought because everything was collapsing. Now you buy because nothing is, but sentiment thinks it might.